In Mountain View, California, the beating heart of Silicon Valley, a company quietly began rewriting how the world's data flows. Its name was Confluent. Back in 2014, three engineers from LinkedIn, Jay Krebs, Neha Narkady, and Jun Rao, came together around a shared realization that data should not be static. For decades, corporations had treated information as something to be stored, cataloged, and retrieved later. But these engineers believed that the next technological frontier would depend on data in motion, information that constantly moves, updates, and reacts in real time to what's happening in the world. Out of that conviction came one of the most transformative technologies in modern computing, Apache Kafka. Apache Kafka revolutionized how digital systems communicate. Every time you make an online payment, stream a movie, check a stock quote, or use an app powered by artificial intelligence, Kafka is silently working in the background. It allows millions of pieces of data to move seamlessly between systems, securely, instantly, and continuously. Today, Kafka is used by thousands of global enterprises, from banks to tech giants. And it was those same creators who decided to take Kafka from an open source innovation to a scalable business model. That company became Confluent, a platform built to commercialize and expand the idea of real-time data streaming. Confluent's mission was bold, to move beyond data at rest and bring about the age of data in motion. Rather than storing data and analyzing it later, companies could now make decisions as data was being generated. Fraud detection, logistics optimization, customer behavior analysis, everything could now happen live. By the summer of 2021, Confluent went public on the NASDAQ and had priced at $36 per share. On its first trading day, the stock surged and investors hailed it as the Amazon of data. It was viewed as the linchpin of a new real-time economy, one where decisions, predictions, and automation would all happen instantaneously. But beneath this narrative of triumph, something subtle and unsettling began to emerge. By the third quarter of 2025, Confluent reported revenue of roughly $285 million, with $286 million in subscription revenue and 24% year-over-year growth in its cloud business. Every metric looked stellar. Yet, quietly, something began to shift. Large enterprise customers, the backbone of its revenue, were starting to use the platform less. In most companies, such a trend triggers immediate disclosure and detailed investor communications. Executives usually provide context, market shifts, customer transitions, macroeconomic impacts, to reassure stakeholders. But Confluent did none of that. Instead, management called it merely a temporary adjustment. To seasoned investors, that explanation felt thin. In the world of real-time data platforms, customer usage isn't just a number, it's a lifeline. A dip in usage without a clear explanation is a red flag, suggesting possible competitive pressure, pricing issues, or product fatigue. Yet Confluent offered no follow-up data, no Q&A elaboration, no roadmap, just silence. Then, almost as if on cue, a shareholder investigation was launched. Its purpose: to determine whether the decline in customer usage had been properly disclosed or whether management had withheld critical information. The timing was uncanny. Normally, these investigations are initiated weeks or even months after earnings reports. This one began immediately after Confluent's quarterly announcement. Such rapid legal escalation hinted that someone, perhaps an insider, perhaps a regulator, already suspected something. The market began to whisper. And then came the bombshell. In October 2025, global news outlets reported that Confluent was exploring a possible sale. Yet the company issued no denial, no confirmation, nothing. This was highly unusual. When rumors of a sale surface, public companies almost always respond quickly. They either deny the story to stabilize the stock or confirm that preliminary talks are underway. Silence, by contrast, invites speculation, and speculation can move markets violently. But Confluent remained silent, and silence in this case was deafening. What made this even more mysterious was the company's trajectory. Revenue was up, losses were narrowing, profit margins were improving. Normally, companies consider selling themselves when their growth plateaus or when they're under strategic or financial pressure. Confluent, by every available metric, was on the rise. So why would a company performing well, one that had just surpassed expectations, consider selling? Was this a defensive maneuver, a hidden deal? Or was it a signal that something even bigger was unfolding behind the scenes? To find clues, analysts looked backward to an event that occurred a year earlier. In May 2024, CEO Jay Krebs joined the board of directors at Anthropic, one of the world's most influential artificial intelligence firms. For a sitting CEO of a major public tech company to join another corporation's board, especially one in a potentially overlapping industry, is extraordinarily rare. Typically, CEOs avoid such commitments to prevent conflicts of interest or distraction. Krebs' decision, therefore, was not just unusual, it was strategic. Soon after, Confluent's public communications began to change tone. The word AI started appearing everywhere in press releases, interviews, and investor calls. The company began positioning itself as the data backbone for the AI era, emphasizing real-time pipelines for machine learning models. Confluent, it seemed, was preparing to evolve from a data infrastructure company into something larger, a connective nervous system for artificial intelligence itself. Then, in January 2023, Confluent made another bold move. It acquired Flink, a leader in stream processing technology. This acquisition expanded Confluent's reach from moving data to interpreting it, analyzing streams in real time, detecting patterns, and generating predictive insights. In other words, Confluent was now not only enabling the movement of data, but also teaching machines how to understand it. Yet again, the timing raised eyebrows. The company was still unprofitable when it made this acquisition, a period when most firms would prioritize stabilization. But Confluent pressed forward, suggesting that it was preparing for a future market structure in which AI would dominate and real-time data would be the fuel that powered it. In September 2025, Confluent appointed Stephen Deasy as its new Chief Technology Officer. Typically, a CTO transition signals a period of internal strengthening, refining infrastructure, stabilizing engineering teams, and refining long-term product vision. But within a month, Confluent found itself at the center of acquisition rumors. The proximity of these events, a leadership shift followed by potential sales speculation, was impossible to ignore. Today, Confluent is valued at approximately $6.8 billion, with an average analyst price target of $28. The company continues to report strong results, particularly in its cloud segment, yet the market remains uneasy. Investors can't reconcile the contradiction: strong performance but ambiguous strategy. Could Confluent be seeking a merger with a larger cloud provider, Amazon, Google, or Microsoft, to secure its position in the AI race? Or could it be orchestrating a controlled transformation, pivoting from independence to integration within a global AI ecosystem? For a company that built its identity on reading and interpreting data flow, its own trajectory has become unreadable. The firm that helps the world understand information in motion is now the mystery the market cannot decipher. That paradox, the data company that cannot predict its own path, defines the Confluent mystery. The Valuester channel is now inviting you to take part in the next story. If there's a publicly listed, private, or pre-IPO stock or cryptocurrency you're curious about, share it in the comments. Your suggestion could become the next deep dive investigation we feature. And to everyone who watches, subscribes, likes, comments, and shares, thank you. Your engagement is what keeps this channel alive. We'll continue to bring you sharper insights, richer stories, and deeper analyses to help you see what others might be missing. This was Valuester.